Bank stocks are seeing volatility around the world. So what impact will these developments have on GCC banks? I'm joined by Omar Bakir, market analyst at XTB. Thank you for joining us today, Omar. Now, European banking stocks are tanking today. The U.S. banking sector is suffering the fallout from the collapse of SVB and Signature Bank. And you say inflation is to blame.
So basically, we have to go back to the origin or the core of the problem, which is when the U.S. Fed, they decided to inject the $3 trillion into the markets. They created an artificial growth, and now they started facing a year ago until today. They are facing the inflation, the high numbers of inflation, and they are trying to fight it or to decrease it as much as possible with increasing the interest rates. Now, increasing the interest rates, it has so many disadvantages. One of them is that, as we are seeing recently, a lot of the banks are invested heavily in the bonds, in the U.S. Treasury bonds. Therefore, when investors try to start pulling out their money or withdrawing their investments, at a certain point, those banks would have to sell at a lower price of those bonds. And therefore, some of the banks, like Silicon Valley, had a crash. And therefore, the Europeans as well, the European banks as well, are having this fear that this scenario might be repeated. Therefore, starting from today, they are injecting more and more liquidity into their banks to avoid such a disaster scenario.
Thank you for the background. Now, let's talk about today. SNB has lost over $1 billion of its $1.5 billion investment in Credit Suisse. Is this the worst of the consequences in the GCC?
Well, yes, I believe this could be the worst consequences or the worst impact on the GCC. However, 1.5 billion is not a big amount to be worried about the banking sectors in the GCC, especially that the GCC banking systems or the strategies they follow, the investments they have, the oil, the real estate, and everything else, it's way too different from the US and Europe. Therefore, we highly doubt that that a big impact might hit the GCC region. In case an impact should happen, it could be very slight.
And how exposed would you say GCC banks are to those in the US?
Well, since the strategy that the GCC banks follow are different from the US, we believe it's not going to have a big impact from the domino effect, if we can call it this way. So basically in the GCC, they have real estate, they have tourism, they have the oil, they have many other factors, and they have enough liquidity in their banks to avoid such crises. Again, a slight impact might happen, but it's nothing to cause fear from the scenarios that are happening in Europe and in the US.
And just staying with oil prices, we've seen them drop to $65 a barrel today. When do you anticipate they will recover, or will they drop further?
Well, basically, we have two main reasons for the drop in the oil prices. First of all, the interest rates by the Feds are going to come this week. So investors usually they become more cautious about it. That's the first reason. The second main reason, which makes perfect sense, that since the banks are having a trouble in the late period, so the demand will decrease in a very natural way. So I don't think the prices of the oil is something to be worried about. In fact, it's just a normal reaction towards what's happening recently in the markets and in the banks in Europe and in US.
And just on that, what's your prediction for the Fed's next rate hike?
Well, basically, regardless of the Fed's rates, I think what's more important right now is to focus on how the banks in US and in Europe are going to deal with the crisis that we are living right now. So in case they keep on supporting the banks that are most affected by this crisis, by liquidity, I think this should hold on the balance in the meantime until they find a better solution for it.
Okay, thanks for joining us, Omar Bakir, market analyst at XTB.